Let's welcome our market master for the day, Vetri Subramaniam, Chief Investment Officer at Religare Invesco Mutual Fund. Good morning, Vetri. Good to have you with us. Well, first your note on the markets itself. We put behind such a good year. Will 2015 turn out to be at least as good or almost as good?
Good morning, Lata. Well, once you've had a good year like 2014 was, it's a bit difficult to expect to build on that or repeat it very easily. I think the key challenge for the economy is that, or rather for the market, is that even though the economy we think will gradually start to improve and perhaps do better by the time we get to the end of the year, from a market point of view, valuations are no longer in the cheap territory. They're not absurdly rich, but really to kind of expect that you'll see further P multiple expansion from these levels immediately is a bit hard to see, and therefore I think the market's performance is going to be related a lot more to underlying earnings growth. The earnings forecast for FY 2016, if you look at the consensus numbers, is about 17% odd. But even over there, I think one reason why that percentage number is 17% is that the actual FY 15 earnings have seen some cuts. But I think there will be some acceleration. There are low levels of capacity utilization across a large number of industries. So, I would tend to think that whatever outcomes that you see this year for the market will be more closely related to earnings growth rather than P multiple change, which is very different from last year, because if you look at last year's 30% move in the market, 2/3 of that came from a change in the P multiple and only 1/3 came from earnings growth.
Okay. Vetri, hi, good morning. Thank you for joining us and Happy New Year to you and your team. There are a lot of big global events that are lined up this week, the ECB policy, the Greek elections, and in this fortnight there's the FOMC meeting as well. What would top your list in terms of key triggers for this market, and which way do you think it could take the markets?
Well, I honestly don't have a crystal ball, and if you look at the history of what's happened over the last few years, it's impossible to foretell what might happen and what the outcomes will be with some of these large macro events. Surely that is something that we should worry about, but really I think we're at a point where what we are more happy doing is taking a call on the companies that we own, and as long as we believe these companies are well placed to benefit from a recovery in growth in India, I think that's the way we are happy to position our portfolio. And there's no real way to insulate yourself from some of the large risks that you mentioned. Will these eventually have an impact on economic growth in India? Will it affect our financial markets? Certainly there are linkages, and I can't wish them away, but it's very hard to build them into your underlying portfolio construction, and therefore at some level we tend not to focus too much on these things when we are trying to manage a portfolio for the long term.
Okay, let me come back to then the domestic theme that you raised, earnings growth. Are you confident of that 17% earnings growth? We have not seen so much by way of growth in the macros as well. That last MMFSL number seems to indicate some very deep stress in the market.
It's certainly a big challenge, Lata. I mean, if you look at what companies are saying, even as they start talking to us, during the course of this earnings season, I think everybody is continuing to repeat the same message, which is that sentiment has improved, but really activity has not really improved as yet very significantly. That's also visible in the numbers that you're seeing in terms of corporate earnings growth, or even in the forecast for corporate earnings growth. The estimate is that for the December quarter, corporate earnings growth was just about in the very low single-digit range. So underlying growth trends are still very weak, and honestly when you talk about that 16-17% consensus earnings growth for the market in 2016, the underlying premise is that there will be some pickup in revenue growth, and only based on that pickup in revenue growth are you likely to see the benefit of operating leverage for a lot of companies which are currently operating at low levels of capacity utilization. If the top line growth is going to be in the low single digits, then you may not get that expansion in margins and the increase in profitability ahead of growth in revenues. So I think it's very important that we see that number. These are still early days. It's a very nascent recovery, honestly, at this point of time. So you've got to be a little careful in terms of where you want to lay those positions down.
Will the rate scenario or the rate cycle help? Well, before that, how much are you expecting by way of rate cuts, and how would you play that?
Again, if you look at the consensus, I think it's about 50 to 75 basis points over the course of the year. I think we're sort of comfortable with that. The fact that it was cut last week was a surprise, but, I think from the way we look at portfolios, it doesn't really matter because it doesn't change our forecast for what we think over the rest of the year. But, this is very hard business in terms of getting that exact number right. So I think what we are more focused on is that there are clear disinflationary trends which are visible. The growth pickup is still very nascent, so in a way, that's a good thing from an inflation outlook point of view because producers don't have pricing power at this point of time. So, from our point of view, I think we're quite happy that there will be some downward movement in rates over the course of the year. But I think the important thing to keep in mind is that a lot of the companies that we talk to are already telling us that over the last 2 or 3 quarters, they've already seen a 50 to 75 basis point drop in some of their borrowing costs because they've been going to the market and raising money rather than to the bank. So I think in terms of the visibility of lower borrowing costs, that will actually be visible, I think, perhaps even in this March quarter. And, the market will monitor what the RBI does, but I think the general trajectory is down, and that will create, tailwind for interest rate cyclicals.
Okay. I was going through some of the funds that you manage, Vetri, and across the schemes, you have lowered your holdings in the oil PSUs, especially in names like ONGC, BPCL, etc. Is it because of the ad hoc subsidy regime, or is it because of the price appreciation, which has been considerable for some of these oil marketing companies in the year gone by?
Well, the honest answer to that is all of the above, and all the factors that you mentioned play a role in that. But I think clearly for the upstream producers, this has been an opportunity lost right through the years when crude prices averaged well in excess of $95 a barrel. These companies realized only, $45 to $50 a barrel through that entire period. And we are eventually exiting the entire subsidy regime when the actual market price has actually come down to a correspondingly similar level of about $50 odd. Now, this has been a great loss of value to these upstream oil companies, and I think this has significantly hurt minority shareholders. And I hope we see a lot more transparency in the exact pricing mechanism going ahead. I think the government itself has indicated that they've had to back off on the disinvestment of ONGC because investors are asking for transparency on the entire sharing regime. I hope we will see that. And once we can see that, then we can take a much clearer view in terms of what the outlook is for these companies. But we need to have a very transparent view. And I think for a government which needs to raise so much resources from public sector companies, it's actually quite shocking that they're not able to put out a clear, sort of formula in terms of how this entire subsidy regime will work for the oil sector. I think some of these policy-related issues are also troubling some of the other PSU companies that they want to bring to disinvestment. And I think it's very important that the government understands that when these companies are listed, they are equally accountable to us as minority shareholders or any other, minority shareholder of the company. And therefore, you need to bring the best quality corporate governance to the table. And honestly, in some of these PSUs, corporate governance in terms of government policy actions hurting our interests as minority shareholders has been downright deplorable.
Oh, absolutely, and it's perhaps most deplorable in the oil PSUs. We'll come to let's talk about financials. Actually, you've been raising your stake in financials in almost all your funds. Is that a trend that will continue in the current year?
Right. So just step back a moment, Lata. I mean, if you look at the economy kind of recovering, then clearly we want to be positioned in what we would call pro-cyclical areas, which is essentially financials, industrials, and also in the consumer discretionary area. These are the sectors that would benefit from a recovery in domestic economic growth and also lower interest rates. Our favorite sector to play this, honestly, going back almost 1.5 years, maybe even 2 years, was actually the industrials basket, where valuations were very, very cheap. But, after the run-up that's happened over the last 18 months, industrials are actually no longer cheap. They're quite expensive. And because of the low levels of capacity utilization and because the entire PPP infrastructure model is still sort of broken, we don't see industrial capex or infrastructure capex reviving in a hurry. valuations, as I said, are already expensive. On the other hand, in both consumer discretionary, which is the auto, white goods, retailing, that kind of stuff, as well as in financials, stock prices have moved up, but valuations still haven't gone to extreme levels. So from the point of view of having a pro-cyclical bias in the portfolio, we've tended to favor incrementally financials and discretionary far more than we have industrials. If anything, we've reduced industrial weightages because of the run-up in valuation and preferred the other two areas in terms of a pro-cyclical tilt.
Okay, but in that cyclical tilt, would you want to churn? I mean, NBFCs were the toast of the market, at least some of them, because of this perceived cheapening of wholesale finance. But now MMFSL is telling you about the growth pains, about the quality of the book as well. So, how would you differentiate within the financial space itself?
Well, I mean, asset quality is a key concern, and I think our underlying principle in financials has always been to sort of back companies on the banking side which have a strong liability franchise, and at the same time look at companies where their asset side has been sort of well managed in terms of credit quality. So, stocks that don't meet those parameters, typically we've not held in our portfolio very significantly. So, I think there are each of these companies in the NBFC space has very different business models. The mortgage guys, the auto guys, the used CV guys, the consumer financing companies. So each of them has a very different business model, and their credit cycles are very different. So I would be a bit careful about extrapolating what you're seeing in one automobile financier to other NBFCs. These business models are very different. But certainly the issue that you raised is relevant, and we will have to watch out for it. And this is the general feedback that we're getting from everywhere, which is that on-ground activity is still very, very slow, and it shouldn't come as a surprise that the pain of that is being felt by some of the financiers.
Vetri, you spoke about your disappointment as a minority shareholder with public sector companies, but are you noticing some improvement? For instance, at that Gyan Sangam we heard about the quality of the board of PSU banks being improved. Is that something you would latch on to?
No, absolutely. I think we've heard, a few positive noises come out from this government, including some of the statements that were made at the Gyan Sangam in terms of non-interference in the operations of these entities. But I think it needs to go beyond the PSU banks to all PSU companies. And I think eventually somewhere we need to break the reporting link of PSUs to ministry departments, to the secretary and the minister concerned. The reporting should be to a national trust which owns all these companies for the benefit of all citizens of the country, and that company could be made accountable to Parliament, but the direct link between the executive and the legislature and these companies needs to be broken by putting in place an independent body between the two, and that independent body then needs to make sure that these companies are run not necessarily keeping in mind what I hear many people say, which is the public sector character, because if you want to maintain the public sector character, then don't list these companies. But if you list these companies, you are answerable to us as minority shareholders, and then you need to make sure that these companies are managed professionally and not necessarily keeping in character with public sector.
No, that point is taken, Vetri. I mean, you put it very neatly, but that we are not getting there just yet. The Naya company has also spoken about holding all the public sector banks in the form of a sovereign wealth fund. We are still a distance away from it, but yet some progress has been made. My point is, since basically you are looking like you are increasing your stakes in financials in many of your funds, will the tilt be towards public sector banks at all?
No, honestly, from an investment point of view, we tend not to, look at this first cut in terms of private versus public. We prefer to look at where the businesses are fundamentally sound, and this is, if anything, a second cut factor in any investment decision. But I think the direction is positive based on what we've heard, at the Gyan Sangam saying non-interference. I'm saying it needs to go beyond the banks to a lot of other public sector entities as well. So, I think the initial signs are positive, but lots more, needs to be done to give minority shareholders the comfort. Look, this is a very valuable piece of wealth that the country is sitting on. Close to 25% of total market cap is these PSU companies. Now, if you want to have these shares widely held by investors, then you need to make sure that you treat minority shareholders fairly. So I think, and I hope, the previous government, I think, made a complete mess out of this, but I hope this government, they've made the right noises, and they'll move this ball in the right direction.
You have about a 16% exposure to the technology space in your portfolio, Vetri. There's a lot of changes there. I mean, TCS is, losing its large premium. Wipro is gaining ground post its numbers. Within the sector, would you churn?
Well, I can't really answer that question point blank. We'll do what we need to in terms of reorganizing companies within the portfolio. But I think broadly speaking, IT, we're still reasonably comfortable over there. We think valuations are reasonable. Some of them are actually trading at a discount to their long-term averages. And just keep in mind that you're still in an environment at this point of time where I was talking about, revenue growth being in the low single digits for the aggregate economy for the listed companies. And you've got these companies still churning out sequential growth rates of revenue of 2.5–3%. I know some of this is getting vitiated by cross-currency movements, etc. But when you convert it back into rupees, that's still a very healthy rate of growth compared to what we are seeing in our aggregate universe. And given that valuations are cheap, we're happy to own them as part of our portfolio in a balanced manner.
No, I think directly what Sonia is asking is that do you think the king in the IT space is challenged now, and so you expect a churn? May happen, but I really can't give you a point-blank answer on that. We will do what we need to do in terms of changing weights in our portfolio.
Okay, we'll find that out after tracking your portfolio, and the next time you're here, perhaps we'll ask you again. But you also have exposure to the logistics sector, and that's been a big mover in the last many weeks and months. The latest we hear is that Gateway Distriparks could be filing an IPO for its subsidiary Gateway Rail Freight Limited. But just tell us, what is the potential here? Despite the huge run-up that the sector has seen, do you think it still makes sense to stay invested?
You're right. We do have a lot of exposure to companies in the overall sort of logistics and transportation sort of industries. And as a matter of disclosure, we do own Gateway as well in our portfolio. So I can't really speak about any of these individual companies. But it is an area that we like. It's within that industrials basket. And honestly, when we look at it and we see so many companies with challenges, both in terms of their cash flow, in terms of their balance sheet, and in terms of their ability to grow revenues at this point of time, what we are finding is that within this industrial basket, this entire logistics sector is actually doing quite well, and it doesn't suffer from any of the problems which otherwise trouble these companies, specifically cash flow and balance sheet. So we're quite happy to continue owning these companies, and I think a lot of the changes that we are talking about, both in terms of more privatization within railways, infrastructure ownership being privatized. We are talking about GST, which will completely change the dynamics of transportation within the country. All these companies are very well placed to benefit from some of this. So we are happy to stay invested.
Okay, well, Gateway Distriparks itself is going to list Gateway Rail Freight. We understand. What would you watch out for? Only the divestment would be non-news. Would you want them to raise capital?
It is a capital-intensive business, and we've known for a while that there is a large PE investor there who would eventually want to exit at some point of time. So I think the key thing that we would focus on is what kind of IPO is being planned. Is it merely a disinvestment for the existing PE investor to go out, or will it really involve also fresh fundraising? Because I think somewhere the company might need more money to continue growing in this sector. It's a survivor. About 4 or 5 years ago, when all these companies went into this freight space, most of the other companies have actually sort of pulled out of it or gone slow. This is one company that has stayed the course and done well. So we'd like them to continue investing in the core business. I'm
being warned that we're out of time. Very quickly, let me squeeze. The government has made a lot of noise on the infrastructure space. I mean, actual moves as well. Power, coal, even cement broadly in the infra space. What would you like? Which would you latch on to?
I think it's still very slow going over there, Lata. The simple problem right now is I think the PPP model is sort of broken. The entrepreneurs who are at the forefront of that infrastructure build out all have troubled balance sheets. They all want to sell assets rather than to build new assets. Cash flows are strained across the board, and the banks which funded this large capex in infrastructure in the last upcycle, are still struggling with the burden of non-performing loans. So I think there's still a lot of reworking that needs to happen in the infrastructure sector. And I think the area where we'd like the government to focus is on looking at what are the problems that stalled infrastructure projects are facing and trying to get those moving in the first place. And then the second step will be to figure out what's the new model for PPP. Does PPP even work? Should we consider what I think some experts have been talking about, which is a reverse BOT? But I think it needs a completely new thought. And I'm a little disappointed when people still keep talking about PPP, because the facts are in front of you. The whole PPP model is broken. The entrepreneurs are broken. The financial system that funded those PPP projects are broken. And consumers are also frustrated at having to fork out continuous increases in user charges. So I think there's a whole rebalancing which is required of this framework. And, you know, in the last budget, they talked about a new entity that would review the whole PPP thought process. You know, hopefully we'll hear from them soon.
Oh, yes, those are the big themes that the government has to evolve and develop in the days to come. Public governance and public sector companies rebooting the PP model, at least shelving it all together. Vetri, we'll touch base with you on all these issues as and when we discuss them. Thank you very much for joining us with all your perspectives today.